All right, children, welcome back to AP Macroeconomics with your favorite teacher, me, Mr. Fritz. Today we're going to learn about GDP, what counts and what doesn't count, and how to calculate it. So for GDP, just a basic definition. GDP is the final market value of all final goods and services produced within a nation within a year. You should remember this from last year somewhat. GDP stands for gross domestic product. Gross meaning everything added up together. Domestic meaning produced within our borders. And then product, things that are actually made. GDP measures aggregate spending, aggregate income, and aggregate output. Aggregate meaning everything added up together. So we're aggregating our spending. All the spending that we consumers do, all the spending that the government does, and all the spending that foreigners do in our country. I should say foreigners do when they purchase things from our countries, when we export things to them, when we sell things around the world. All right. And then that's also aggregate income, all the money that's going home each year, and aggregate output. What counts and what doesn't count? All final goods in domestic production. So something needs to actually be being made. So it needs to be a good or service. And so all final goods in domestic production for which there is a market transaction in that year. So it means that it has to be made here. It has to be a final good, something that's like it's completely done. And it has to have been made this year, and there had to have been a purchase this year. What doesn't count? Things that don't count are going to be used goods. So if you buy a used car, that's not going to be part of GDP. Intermediate goods, that would be things that firms use to create final products. That would be like if Honda buys tires from Goodyear and then puts them on a car and sells the car to a consumer. You only count the Honda at the end when it's actually being purchased by the consumer. You don't count the tires because they're going to be part of that final good that is the car itself. Non-market production doesn't count either. If you're like a babysitter that just works for a family down the street and they just give you cash and you're not paying taxes on that, that's not going to count. And then black market activity doesn't count. Things like drug dealers and stuff like that, or like illegal arms sales. That doesn't count. Okay. This is how we calculate GDP. This is going to be our main way. This is called the expenditure approach. And we're calculating our aggregate spending, all of the spending that's happening in our economy in that year. So your aggregate spending is going to be C plus I plus G plus X. C being consumption, all the spending that consumers like you and me do each year. I being gross private investment, all the spending that businesses do each year. This is businesses spending on capital goods. We'll talk about that in a minute. G is going to be government spending, so any goods or services the government's buying in a given year. And then X is going to be our net exports. Okay. Consumption spending. This is consumer spending on durable goods, things like a car, your TV, a video game system, a phone. These are things that we're expecting to last upwards of 3 years. That's going to be our durable goods. Non-durable goods would be things like food and paper towels and toilet paper, things like that. Things you don't expect to last very long. Services also count. A teacher, a banker, anybody that works in like financial investment, so like you'd pay them and they go buy stock for you, that would count. People that work at a coffee shop, those are all services. So services are also going to be counting. So any goods or services, any consumer spending on goods and services is going to count. Next, your I is going to be gross private investment. This is private spending in order to increase future output or productivity. So this is essentially businesses buying new capital goods, aka machines and factories and stuff like that. It will also be literally making a new factory. So new construction also counts. So if a business decides to build a new building, new factory equipment, or so if a business decides to build a new factory or build a new building, like Frost built a building downtown this year, like finally opened it this year, that would be investment spending. They built a skyscraper that they could do their business in. Any changes in unsold inventories will also count. So if you get to the end of the year and you're a cereal manufacturer and you still have some flour left over, you're going to count that as part of investment spending because you're going to be using that to turn into a product next year. Stock purchases don't count. You need to like highlight that. That's not the type of investment we're talking about. Investment spending has to be on capital goods. It has to be something that the business is going to use to make more products in the future. Stock doesn't count. That's just part ownership in a company. All right, for letter G, that's going to be government spending. That's all government spending on final goods and services and infrastructure count toward GDP. So if the government is buying anything, like if they buy a plane from Boeing, or if they buy some bombs and guns and stuff for the military, that's going to count as part of GDP. Or if they're spending on infrastructure, like they're paying someone to build a freeway, or paying to build public transportation, like trains and stuff like that, that is going to count as government spending. Transfer payments do not count. Under transfer payments, I need you to write down that that's going to be like welfare, social security, unemployment benefits, any of those things. That's not going to count. And part of the reason we don't count that is because when people receive those payments for unemployment benefits or welfare or something like that, they're going to go spend that money. That's where we're going to count it. It's going to be counted under consumer spending. So when there's a transfer payment, like unemployment benefits going out to people, we're not going to count that money. That does not count. Finally, we have net exports, which is going to be exports minus imports, or you can remember it X minus M. Exports being the things that we sell to other countries, imports being the things that we buy from other countries. So exports is going to be money coming into the US in exchange for our goods and services that we make. Imports is going to be money leaving the US for foreign produced goods. So that's when we buy things from other countries. Net exports can end up being negative. If we buy more from other countries than we sell to them, we'll be in a trade deficit. And so our net exports will come out to a negative number. And I'll show you that in a minute. For the US, that happens to us. We don't have as many factories as we used to. And so we actually buy more things from other countries than we sell to them. That's not necessarily a bad thing, by the way. Don't think of that as like, oh, we're being taken advantage of. That's not what's happening. All right, so the way we calculate this, the income approach. This is another way. We're not going to use this nearly as often, but this is another way. R is going to equal rent, aka the payment for the use of natural resources. So when someone buys cotton in order to turn into t-shirts, what they're paying is called rent. So the money that the people make for selling their cotton is called rent. Okay, wages also. So you're going to add up rent plus wages. Wages are going to be the payment for labor. So that's the money people like us are going to take home when we sell our labor to a company. Then we're going to add I to that. That's interest. That's payment for the use of capital. So if someone's paying to use factory equipment and machines, then the money that they earn is going to be called interest. And then finally, profit. That's payment for entrepreneurship, aka when you own your own business, the money that you make is called profit. So that's the other way to add it up. R plus W plus I plus P. There is also a value added approach that you won't see as often either. Value added provides a dollar value for the amount of goods and services that are produced in a country minus the cost of the inputs like raw materials and labor and stuff like that that are used in that production. So the way we would add this up, flour, almond flour mill is made almond flour. They are going to they have $10,000 worth of flour that they've produced. They sell that to a cookie factory. So they sell that for $10,000. So the value added to the economy by this almond flour mill is $10,000 worth of stuff, $10,000 worth of production. All right, now Tay-Tay's Cookie Company, we have bought that flour for $10,000. So we have $10,000 worth of goods so far. We then turn it into cookies and sell them to places like H-E-B for $13,000. And so the amount of value that the cookie factory has added to the production or the GDP is going to be $3,000 because that $10,000 already exists. So it doesn't count anymore. We can't count it again because you'd be counting it twice. Next, H-E-B bought those cookies for $13,000. They're going to turn around and sell them for $15,000. H-E-B has added $2,000 worth of value to the economy, and our GDP overall is going to be $15,000. This is another one again. I just wanted to show you how it works. You're probably not going to see it too often. Now we're going to work together a practice problem. I'm going to get up on the board and show you how to do it. Before we go, I want to show you just real quick how to calculate GDP. using the expenditure approach. So we're going to look at all the purchases that took place in a country in a given year, and we're going to calculate it up. Just the things that count, leave out things that don't count. First, so remember, our expenditure approach for GDP is going to be C, I, G, and X. So first, C, that's going to be consumer spending. Consumer spending for this country this year is $500. This is always going to be the bulk of your GDP. Consumer spending makes up the largest part of our GDP. Remember, consumer spending is when people like us buy things at the grocery store, go to Starbucks, or pay to go to the movies. Next, the I stands for gross private domestic investment spending. This is when businesses are purchasing capital goods to invest in their ability to produce things in the future. Domestic because it has to be taking place within this country's borders, and gross because we're not accounting for the depreciation that's occurring. All right, so our investment spending is going to be $300. Businesses in this country spent $300 on capital goods this year to increase their ability to produce next year. Next is going to be G, government spending. Remember, this is when the government is buying goods and services. They have to be paying for goods and services, receiving something back. So this unemployment benefits, even though that's money that's being paid out by the government, they're not buying a good or service, they're just sending money to individuals, and so that does not count as part of GDP. That's a net transfer payment. Okay, so government spending. The government bought $400 worth of stuff this year in this country. They bought $400 worth of goods or services. Maybe they paid $200 for an airplane and $200 for the service of somebody building a road. All right, next, finally, we have X for net exports. Remember that net exports is going to be your exports, the things you sell to other countries, minus your imports, the things you buy from other countries. In this country, in this year, they earned $400 in exports. They sold $400 worth of stuff to foreigners. At the same time, they bought $600 worth of imports. They bought $600 worth of stuff from other countries. And so it's 400 minus 600, and we end up with a negative $200 for our net exports. This country spent $200 more on stuff from other places than they earned off selling stuff to other places. Now, all we gotta do is count this up, and that'll be our GDP. So it's 500 plus 300, that's 800. Plus 400, that's 1,200, and then subtract the 200, and we come out with $1,000 GDP for this country in this year. Hooray, we did it. See you next time.